I agree with you. They can't do it in 3 months, but they can do it in 6 months. And you're going to see jobs created in America, cars in America. You build it here, you don't pay any tariff. And that starts on April 2nd. But today, we've got to save lives. But on April 2nd, I think you're going to see a reordering and negotiating with our trading partners and trying to make the world fair and reciprocal.
Hello and welcome to the Week Ahead on the Mirror Podcasts. It's Friday the 7th of March. I'm Dominic Bunning, head of G10 FX Strategy here in London, and I'm delighted to welcome you to this week's podcast after a genuinely seismic week in markets. The US administration followed through on its threat to impose tariffs on Canada and Mexico and increase tariffs further on China. US equity markets continue to struggle, seemingly under the weight of the negative growth risks that these tariffs present. But possibly of more market significance was the German Fiscal announcement on Tuesday, the 4th of March, when incoming Chancellor Merz channeled former ECB President Mario Draghi in vowing to do whatever it takes in the face of increasing economic and defence challenges. German 10-year bund yields jumped from around 2.4% at the start of the week to over 2.9% at one stage on Tuesday, while the euro rallied broadly and aggressively, with euro-dollar rising at its fastest rate since 2015 for any three-day period. So all in all, a very, very volatile week. But after all of that, we'll be trying to give you a sense of what it really means from a macro perspective, what we think happens next, and also getting a preview of what's in store for next week with Jeremy Schwartz, Hannah Liu, and George Buckley. Let's get stuck in.
Tariffs do not create inflation. Printing money creates inflation. You have a balanced budget, there can't be inflation. It doesn't mean one product could be more expensive and one product could be less expensive. But China, I'll give you an example. China has the highest tariffs in the world. In the world. Everything gets tariffed in China, and they don't have inflation. In fact, they have deflation.
That was US Commerce Secretary Howard Lutnick speaking earlier this week on tariffs, and we also heard from him at the top of the podcast, but it's time now to hear what our analysts think. Well, it feels like I say this every week I do the podcast, but it really has been a momentous week in terms of economic developments and news. I think the first big thing to focus on is obviously tariffs. So we've got Jeremy Schwartz from the US team, we've got Hannah Liu from our China economics team, and George Buckley, our chief European economist, to talk about what is actually going on with tariffs and what we think the impacts are. So first of all, we'll go to Jeremy. Look, Jeremy, there's been a lot of headlines about what is in place, what is not in place, what is coming, what is not coming. As things stand, what tariffs have the US administration actually put in place, and what do we expect to come through in the near future?
Sure, Dom. Yeah, and it's certainly been a busy couple of weeks for headlines, and looks like it will continue to be for the next couple of weeks as well. In terms of what's been put in place, 25% tariffs on Canada and Mexico were allowed to go into effect on Tuesday, and an additional 10% of tariffs on China on top of the 10% that was already increased back in February. There was an announcement that auto products might be exempted for 1 month, although we haven't specifically seen the details about which line items might be exempt from that 25% tariff. So in terms of the increase here, this is by far the largest hike in tariffs of either of the Trump administrations. This takes the weighted average effective tariff rate up into the double digits, sort of what we were expecting for the entire trade war, really in a matter of just a couple of months. And it appears as if there's more announcements on the time horizon. So we have the steel and aluminum tariffs, which are set to go into effect on March 12th. And then April 2nd is the real big deadline, where we're expecting these reports from USTR and from the Commerce Department on reciprocal tariffs, as well as reviving a number of the investigations from Trump's first administration on unfair trade practices. So, overall, it's a little bit delicately poised at the moment in terms of what we expect. We do think that this 25% on Canada and Mexico does get rolled back. We think that that's sort of an opening bid, and the aim is to have some type of negotiation. But we do think this is sort of 3 steps forward, 2 steps back. in the process. Each time we do get these deals and these exemptions, the effective tariff rate continues to creep higher and higher. And we do think that that's likely to continue. We continue to think that tariff rates end the year in the double digits, again, back to something like their pre-GATT 1940s levels.
So yeah, all in, it's obviously still it's a pretty chunky move, even looking through the noise. But it's not just the US, I guess, where tariffs have been put in place. Hannah, in China, we've seen a few sort of retaliatory tariffs. What's actually come through from the China side at the moment?
Hey Dominic, thanks for having me. So for China, on the China side, I think it just followed the steps from the US. So just after the US imposed the first 10% tariff on February 4th, Beijing hit back with a 10 to 15% tariffs on the key energy products from the US. And also they added 2 American firms to its unreliable entity list, meaning that these firms could no longer do meaningful business in China. And then this Tuesday, when the second 10% tariff kicks in, China retaliated on a similar manner, slapping a 10 to 15% tariffs on the agricultural products from the US. And also they added 10 more US companies to the blacklist. So it appears on paper, it seems quite a tit for tat, right? But if we look at the bigger picture here, so the US side, they're swinging hard with a 20% tariff hike on all the $500 billion of all Chinese imports. But on the China from the China side, China is countering with only 10 to 15% tariffs on just $36 billion of US goods, which is only 22% of their American imports. So it is quite measured, like they are holding back a sneeze, especially if we compare with how China retaliated back in 2018.
So I love the imagery, holding back a sneeze. Hopefully no one on the podcast needs to sneeze anytime soon. It will get in the way of the recording. Look, it's interesting really there. So Jeremy obviously speaking about quite a big sort of tariff rollout. China may be a bit more restrained for now. In terms of the economic impact, going back to you, Jeremy, how do you actually see this hitting growth and inflation? What are the key kind of numbers you're putting in place here?
Yeah, so the way we're seeing it, these are big enough tariff hikes on large US trading partners. And even if there's some room for manufacturers to cut their prices, for retailers and transport to cut their margins, some of this is going to land in consumer prices. So we do expect to see a noticeable increase in consumer price inflation, particularly for core goods, beginning in the second quarter. In terms of growth, it's a little bit trickier. So on the one hand, tariffs are clearly a negative just from the fiscal side. It's like a consumption tax, there are income effects, and that leads to some pullback in spending and less purchasing power for consumers. On top of that, and we think the more important growth effect is through the uncertainty channel. If businesses don't know what the long-term trade relationships are, if they don't know what their supply chains are going to look like, or what types of retaliation might be coming down the line, that makes it extremely difficult to plan and invest. And something we've noticed already, even before the trade war really started to ramp up, is just the concerns that it might were beginning to impact confidence surveys. So we think that that does have a chilling effect on investment. We think that that's likely to materialize as well relatively soon. And I think we're already clearly seeing it, both in measures of business and consumer sentiment, and now also market sentiment as well, where Fed cuts are increasingly priced in, and there's much more concern about risks to the downside. Now, why do we think that this isn't going to be a recession level event? The thing is, coming into the trade war, the US was in a really good place fundamentally. You were sort of at the early stage of a momentum acceleration for cyclical sectors. Housing and manufacturing and business investment had been in the doldrums for a couple of years, which gave you a lot of headroom to expand. And then you had a significant easing in financial conditions in the run-up to the election and really through the start of the year, which we think could potentially have led to a significant tailwind for a lot of cyclical spending. So, the way we see it, this is more about deflating the momentum pop that was likely to take place post-election. We think growth is slowing to a below-trend pace, but again, those fundamentals and that resilience is still there. And as long as nobody's balance sheet is blowing up, as long as no one reaches liquidity stress or sees any kind of cash flow shock, And as long as the market stress remains relatively contained, we don't see this rising to a recession level shock. So we think the combination of higher inflation, slower but not catastrophic growth actually leads the Fed to stay on hold for a while, which again, I think adds more potential risk of a slump in the medium term.
Yeah, and I think it is interesting the way the market reacts in the recent to the recent tariff announcement. It seems to be much more on the negative growth side. If you look at yield reactions, more to the downside. The dollar even struggling to really rally on the back of tariff announcements, it seems. And actually, that brings me, I think, euro has been an interesting currency in that sense. So I want to go to George now. Look, there's been a lot of other news in Europe, but if we just focus on the tariff impact, how have you guys been thinking about how this impacts Europe? What does it really mean for European growth and inflation, George?
Yeah, thanks, Dom. And it probably won't have it certainly won't have as big an impact on inflation as it would do in the US. And the reason simply is because if with the US putting tariffs on every country, it's going to have a bigger impact on US inflation than individual countries in Europe doing the reverse on the US, because it's only one country that they're applying that to. So in terms of the inflation impact, probably quite limited, and it would require, of course, for that inflation impact to come through some sort of retaliation. In terms of the impact on growth, I think one interesting way to think about this is that on some countries, there are going to be different impacts than on other countries. For example, if you put a 10% extra tariffs on China, those products are still going to be very competitive because they were very cheap in the first place. That probably isn't true for Europe, so it might have clearly a dent in export growth, and that will obviously impact overall economic growth. Obviously, retaliation, something to think about as well, but which will clearly impact imports as well. But certainly the initial impact will be, and I think this is what the ECB is going to focus on, is the impact on economic growth rather than the inflationary effect.
Great, thank you, George. And yeah, we'll go to Asia and Hannah and China. What is really going to happen in terms of China growth and China inflation? I know there's also now been sort of a bit of a policy push as well coming out of the MPC. So how are you seeing the tariff story play out against the kind of the policy support that may be coming through?
And so from the short term, right? So from the short term, frankly speaking, I think it's much milder than we expected. If we look at the stock market rally, so the Hong Kong Tech Index just hit its 3-year high during the week, which means that markets are not really panicking at all. So now the question is, when will these tariffs start to bite, and by how much? So we are assuming that after the first quarter, when we expect the tariff will hit, the exports will face a strong headwinds when the front-loading effect starts to fade away. And also, according to our estimates, U.S. currently accounts for 20% of China's exports, with 5% through rerouting from a third country. The 20% is still a big chunk. So with an assumption that additional 15% tariffs still ahead on top of the 20% tariffs already announced. So we project a 0% export growth for this year. This is a significant down from the 6% growth from last year. So with this, GDP growth could be dragged down by 1%. And back to this week's MPC. So the MPC set the GDP growth target at 5%. So to counter the drag from the export sector, the government has to turn to the other side for rescue. So they're now turning to the domestic consumption. So they ramp up a very aggressive fiscal push. They raised the in-budget GDP, in-budget fiscal deficit to 4% of GDP from 3% last year. And they also boosted the off-budget special government bond quotas, and which means adding these two numbers together, the augmented fiscal spending growth will jump from 5% last year to 10% year-on-year growth this year, just to shore up the domestic consumption and stabilize the property market. Although this total package was largely in line with the market expectation, to be fair, it's still a big step from the last year.
Okay, so if I was going to maybe summarize that briefly in terms of the tariff story, lots of tariffs coming from the US, pretty chunky, pretty big impact on US inflation and a drag on US growth, maybe potentially big impact on China, but some decent sort of signs of policy pushback there, and especially I think in Europe, which we'll discuss now, signs of a significant policy stimulus coming to maybe offset some of that tariff impact. So I think it's all in flux. It's all really interesting. Thanks for that discussion. But we'll move now, I think, to talk about Europe in a bit more detail. Thank you, everyone.
I want to say this very clearly. In view of the threats to our freedom and peace on our continent, the same must now apply to our defense, whatever it takes.
Whatever it takes.
That was incoming German Chancellor Merz channeling his inner Mario Draghi there, talking about doing whatever it takes to take on the new challenges that Europe faces. George, it seems like it's been a pretty momentous week here in terms of those German fiscal announcements. What have they actually announced that they're going to do?
It is momentous indeed. Lots of ways to describe this. Momentous is a good one. 500 billion of infrastructure spending over the next 10 years, so 50 billion a year in Germany. Germany also excluding defence above 1% of GDP from the debt brake, which means that creates an extra 1% of fiscal space immediately. The German government could use that somewhere else. The EU repurposing unused funds from the pandemic support program and regional funds, and also saying to countries, well, we might at least exclude from the fiscal rules the extra defence spending that you might commit to over the course of the next few years. So that's a substantial fiscal easing. We think it could be about up to 250 billion euros a year, or almost 1.5% of European GDP. That's probably an upper limit, but it just gives you a sense of the scale of this fiscal easing, which we've heard from not just Germany, but also the European Union.
Yeah, so with that scale of fiscal easing, I assume it's going to have a pretty big impact on some of your forecasts. Have you changed your growth and inflation numbers, and does it change the ECB view that much?
Well, we changed them very quickly. In the aftermath of that, we've decided to add a couple of tenths onto GDP. It's not immediate. I mean, in fact, there might even be a negative repercussion straight away, to the extent that look at what the markets have done. I mean, the markets are now 50 basis points higher on 10-year yields in Germany over the space of just a few days. Now, that obviously has potential negative repercussions for growth, but that's not really what we're focused on here. What we're really focused on is the impact of this fiscal easing, and it will be positive, very positive. We think it could add a couple of tenths per quarter to economic growth by the end of our forecast horizon, which is end of 2026. Might not, as I say, might not happen immediately, but it'll ramp up to that, we think, by the and it will also therefore have an effect on inflation. A lot depends upon how much of this is directed towards structural changes, which might improve the supply potential of the economy. But in the very near term, it's going to be a demand issue, which is the focus, which will mean higher demand relative to unchanged supply in the near term, at least, which could add to inflation. All of that, we think, will stop the ECB out more quickly in its rate cutting program. They cut interest rates just this week. We think they will cut one more time in June. That means missing out on April. It means not doing the September, which we thought they would before. It means ending at 225 on rates rather than the 175 we thought they would before. So higher growth, higher inflation, and higher interest rates.
It's interesting, George, you mentioned, the knock-on impact. It's really fascinating how quickly it's had an impact on markets, to be fair. Maybe the growth numbers come through slower, but, Euro reacting very, very aggressively. And I think, from our perspective, the outperformance can certainly continue and the sentiment can continue. While I'm on sentiment, I think next week we do get our first glimpse, I guess, of post-announcement sentiment data in the form of the Centix survey. There's a few other data points next week to watch. What are you thinking around the European data next week?
Well, certainly, I think there's a risk that the Centix is important because it's the first survey which is not just published in the month. It's the first survey which is actually conducted during the month, and it will be conducted over this weekend. What that means is that it could contain some element. Centix, sentiment index could contain some element of what's happened and these more positive announcements on fiscal policy. We also get German industrial production. German industrial production has been very weak. It's still substantially down on where it was pre-pandemic. And I think this is exactly what these fiscal decisions are aiming to change, to get Germany out of the economic hole that it's been in. It's the only country where we've seen industrial production so weak. It's the only country where GDP hasn't recovered or has only just recovered its pre-pandemic levels. So some data to watch next week, but of course it's going to take a while for industrial production to reflect these fiscal changes. May not be the case with sentiment. So look out for that Centix survey.
Great. Thanks very much, George. Have a great week.
Thank you. You too.
And just back to you, Hannah. In terms of the week ahead, is there anything major you wanted to flag in terms of data developments?
Sure. So in China, we have inflation and credit data coming out next week. And on inflation, we expect CPI to drop to minus 0.4% in February from 0.5% in January. This is mostly due to the Chinese New Year calendar effect, because an earlier Chinese New Year for this year. And for PPI number, we expect the data to drop to 2.0% in February from 1.9% in January. And for credit data, we expect the growth of outstanding aggregate financing to rise to 8.3% in February from 8.0% in January. This is boosted by the fast pace of government bond issuance, like I mentioned before.
Great. Thanks very much, Anna. Just while we're going through the data, it's worth thinking about one other point we haven't touched on, which is Japan. This week, we're going to get the final release of some of the wage negotiations, where the demands from the unions have jumped up again as of last week. So the overall demand is coming in over 6% in terms of year-on-year wage gains. So although the final figure probably won't be that high, certainly something to watch on Friday, the 14th of March. If we do get another strong number in terms of those wage negotiations, it could certainly feed in to a bit more expectation that the BOJ can continue to hike and that the Japanese yen can probably continue to outperform. We're going to finish where we started with Jeremy. Jeremy, is there anything else for you to flag in the data this week?
Sure, Dom. So, beyond the constant stream of trade war headlines, we also have a pretty important CPI report next week. We're expecting to get another relatively high reading, around 29 basis points month on month for core CPI in February. We think that the impact from some of the seasonal price hikes to start the year, it reversed, but only partially. Some of that tends to get carried forward through the next couple of months in Q1. And on top of that, we think that non-auto core goods prices likely increased in February as well. So again, based on the year-on-year measures, this will still mark some progress for the Fed, but it'll be another month of printing above a 2% annualized pace and leaves you with a relatively high jumping-off point before any of the price hikes related to tariffs have even had a chance to materialize in the data yet.
Great. Thanks very much, Jeremy. Have a good week. That's it for now, and thank you again for joining us at Nomura Research on the week ahead, which was, as always, expertly edited and produced by John Dalton. If you enjoyed the content, please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or wherever it is you get your podcasts. And please feel free to leave your feedback, good or bad, and share this podcast with anyone you think might be interested. You can also check out nomuraconnects.com for more of our research and updates. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura. Connecting markets, East and West.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.